Austan Goolsbee was an economics professor at the venerated University of Chicago before he joined the team put together by Barack Obama to respond to the financial panic of 2008 and the recession that followed. He returned to academia, but in 2022, he was tapped for every economist's dream job: president and CEO of one of America's 12 Federal Reserve banks. And he joins us now from Chicago. Okay, thank you so much for being here. The new numbers from the University of Michigan's Index of Consumer Sentiment, which is the gold standard for gauging the direction of consumer spending that constitutes, I think, something like 80% of our economy, show increasing concern about rising prices. This comes after an alarming report that said January was the fourth consecutive month in which the rate of inflation grew. Give us the big picture, Mr. President. How's the economy going, and what's the short-term outlook?
Yeah, there's a lot to the economy. This University of Michigan number you're citing wasn't a great number. Consumer confidence fell. The expectations of where they see inflation over the next year and the next couple of years went up. But it's only 1 month of data. And I always say 1 month is no months. You know, you need at least 2 or 3 months for that to count as a full month. I think overall, the strongest part of the economy is now and continues to be the robust job market, and the weakest part of the economy, everyone knows, is that inflation got way higher than it should have been, and we've been fighting to bring it down. If you take the through line over the last year and a half, the inflation rate has come down a fair amount. And we did that without a recession, which was good, but we must complete the job. And we now got a lot of balls in the air that are just kind of clouding I'm mixing metaphors, but it's clouding the view. And so we just got to kind of clear out some of that before I think we can figure out where we are on the through line.
Okay, let's show folks the trend line here because we see, as you alluded to, January had the largest monthly increase since August of 23. So yes, definitely, you can see the trend line pushing down there month after month after month. But now we've got 4 months in a row going the other direction. How confident are you that you're going to be able to? I know the target rate's 2%. How confident are you that we're going to get back to that or get there soon?
I'm still comfortable that we are on path to get back to 2%. The thing to remember about the numbers, if we would really get down in the weeds, is that's a backward-looking 12 months. So 11 of the 12 months that count in the one-year average, we already knew what they were. What matters are the new months that come in. As you say, the January month wasn't a great month, but that followed a couple of pretty solid months, and we just are going to have to see if the trend of the last half year, let's call it, continue, which looks like it's going down to more like going down to 2%. Housing inflation finally getting some of the relief that we've been wanting. Services side improvement. And now with policy and geopolitics scrambling the picture a little bit, and potentially raising prices, I think we got to, in the short run, be a little cautious, even though I still think the fundamentals on the economy point to strong job market, strong growth. As you highlight, consumer spending continued to be robust and inflation coming down. So over the longer term, I still have some comfort, but in the short term, it's going to be a little bumpy.
Okay, earlier this month, the Bank of England made its third interest rate cut in 6 months in a bid to stave off a recession. Now, I know you're not going to tell me when the next, what you guys are going to do at the next Federal Reserve meeting in March, but as we get closer to that and there are increasing calls for rate cuts, how are you thinking about all of that as you make the decision?
Well, Chris, as you know, the U.S. growth performance has been a lot stronger than the Europeans coming out of COVID. So I'm not surprised that you're seeing a lot of the European banks diverging a little bit in their strategy. I don't think that we're on the edge of recession at this moment. We've got the unemployment rate still coming down a little bit. Looks to me like we kind of stabilized at a full employment type of a setting. I still believe that if you take the statements of the other members of the FOMC. I'm only supposed to speak for myself. I don't speak for anybody else. But we put out the so-called dot plot, and in that dot plot, they ask, where do you think rates will eventually settle? And the vast majority of people on the committee believe rates are going to go down a fair amount from where they are today. They've already come down a full percentage point in the fall of last year. And I think once we get past this period of uncertainty, let's call it, period of hesitation where we're trying to see where we are, I still anticipate rates go down a fair bit from where they are today.
Okay. Last thing was that last week, President Trump signed an executive order, and he declared that he has direct control over this sort of semi-autonomous agencies that make up Washington's alphabet soup: the Federal Trade Commission, the Federal Communications Commission, the Securities and Exchange Commission, da-da-da-da-da. The Fed was not on that list, but many in Trump's orbit they have designs on the independence of the bank and the job of Chairman Jerome Powell. Does that factor into, do you guys think about that kind of stuff? Do you talk about that kind of stuff as you make your decisions and do what you do?
Not on the interest rate. I mean, we put out the minutes that you can just go look up exactly what we talk about at the meetings. And after a delay, they'll release the full transcripts. You can see word for word what people think about. I've been in the Fed a little over 2 years. I came from the world of economics, as you highlighted. There's close to unanimity among economists that the independence of a central bank is important. And by that, I just mean that the sitting administration does not tell the central bank what to do with interest rates. And the reason why economists are unanimous on that point is if you look around the world at times and countries where the central government can tell the central bank what to do with interest rates, inflation is worse, growth is worse, the outcomes are significantly inferior, and I think Fed independence is very important.
Okay. If you have ever seen a great big letter G on the left side of a dollar bill, it means it came from the Federal Reserve Bank of Chicago, so you might know him already.
You're exactly right.
But
You're
if you
exactly
don't,
right.
There he is, Austan Goolsbee. We thank you very much for your time. Good luck out there.
Chris, great to see you. Thank you for having me.
You bet.